Imagine this. Maybe you're running a business, could be big, could be small, and suddenly, boom, its entire nervous system, its IT infrastructure just, well, crashes.
Oof, yeah.
Millions of computers worldwide suddenly offline.
Huh.
Critical operations just frozen solid. And look, this wasn't some hypothetical nightmare scenario. It was very real for a lot of companies last summer.
I remember that well. Chaos.
Exactly. It's the kind of really high-stakes disruption businesses are facing more and more, especially as they, shift everything to the cloud and manage these huge remote workforces.
The attack surface just keeps expanding.
It does. So in this kind of new world, having robust, intelligent cybersecurity isn't just like a nice-to-have safeguard. It's fundamental. It's basically the foundation for survival and growth.
It's absolutely essential.
And right at the heart of this critical need, you've got artificial intelligence, AI, completely reshaping the landscape.
It's the game changer.
So for you, our listener, trying to navigate this pretty complex, fast-moving market, understanding where the smart money might be moving in AI cybersecurity is, well, it's absolutely paramount.
Couldn't agree more.
So, okay, our mission today is pretty clear. We want to cut through the noise, cut through the hype, and give you a shortcut to being really well-informed about this dynamic market, specifically from an investor's viewpoint.
Let's do it.
We're diving deep into a recent analysis from the Motley Fool. It's titled AI Cybersecurity Stocks, Buy, Sell, or Hold. The author is Adam Levy, dated August 24th, 2025.
Good source. They usually have solid insights.
Yeah, so we're going to pull out the most important nuggets, highlight which companies seem to be, truly standing out, and crucially, uncover why a company's valuation can be just as vital as its cutting-edge tech.
That's a perfect setup, actually, because before we even get into specific company names, it's so vital to understand the powerful market dynamics that are, underneath it all.
Right, the content.
Exactly. What's truly fascinating here, I think, is this undeniable industry trend towards consolidation. You see, customers, they're not really looking to stitch together a patchwork of security tools from 10 different vendors anymore.
Too complicated, too many gaps.
Precisely. They're increasingly demanding one-stop shops for all their diverse and, frankly, evolving cybersecurity needs.
Makes sense. Simplify things.
And this shift, well, it gives the biggest companies in this space an almost, I'd say, unfair advantage. Think about it this way. The more customers they onboard,
the more data they get.
Exactly. More customers mean more data flowing into their systems. And this data, in turn, feeds and dramatically improves their AI models, makes them smarter, faster, more predictive.
It's that feedback loop.
It's a powerful self-reinforcing feedback loop. It lets them offer truly advanced features and build a really significant competitive moat. But, and this is a big but we need to explore, it's also critical for us and for you, the listener, to get the challenge here. Strong tech is essential, no doubt, but a smart investment, that also requires an attractive valuation.
The price tag.
We'll see how even a really promising, innovative company can still be considered overpriced, maybe making it a sell or at least a hold, despite its impressive technology.
Absolutely. And that foundational shift you mentioned, it's enormous. Businesses moving entire infrastructures to the cloud, supporting a global, often remote workforce. It's truly supercharged the demand for comprehensive security.
Day and night difference from, say, 10 years ago.
Totally. And as you highlighted, this naturally drives this massive consolidation. Companies are building out these extensive, sort of all-encompassing software systems to meet these complex needs.
Yeah, sprawling platforms now.
Right, which leads to fewer but much, much larger players dominating the market. And here's where it gets really interesting, I think.
Yep.
This trend naturally favors companies that can leverage just vast amounts of customer data for machine learning for their AI applications. It's not just about having AI anymore.
No, it's table stakes now, almost.
It's about having enough data, enough diverse data, to make that AI genuinely smarter and more effective than anyone else's. That's what creates this incredibly powerful competitive moat, makes it really hard for smaller guys to catch up.
It's almost a winner-take-most kind of dynamic emerging.
It feels that way.
And, if we connect this to the bigger picture, this whole data-driven AI approach is precisely what lets these leading firms offer genuinely advanced, proactive security.
Not just reacting, but predicting.
Exactly. They're ideally predicting and even preventing threats before they happen. That's the holy grail. And this is why the article suggests, look, only a handful of cybersecurity stocks are truly worth investing in right now.
Because only a few have that scale.
Because only a few can really achieve that critical mass of scale and data advantage. It just reinforces the point. A strong company is vital, yes, but its stock shares also have to offer attractive value.
Right.
As investors, we often get caught up in the exciting story or the rapid growth, but not every high-performing company makes for a smart buy at any price.
It's like that vintage car analogy you mentioned earlier.
Yeah, exactly. It might be a magnificent car, but if you pay $1 million for it, well, good luck getting your money back, let alone making a profit. The starting price matters.
That's a perfect analogy.
Yep.
So, okay, who's the poster child for this valuation dilemma then?
Mhm.
A company that's been a market darling, maybe, but one that the article suggests might have flown a bit too close to the sun, valuation-wise?
Well, the article points squarely at CrowdStrike, ticker CRWD.
CrowdStrike, okay. Big name.
Huge name. As of the article's date, August 21st, 2025, it had a market cap around $103 billion, trading at 413.92 so a share.
Wow. Hefty valuation.
Right.
Okay, let's unpack this. What happened there? The article mentions a setback.
It does. CrowdStrike suffered a pretty significant setback last summer. Remember that huge IT outage?
Oh, yeah, I do remember that. It was caused by a software update, wasn't it?
A flawed software update, yeah. It crashed millions, literally millions, of Windows-based computers worldwide. It caused massive disruption for businesses, airlines, hospitals, you name it.
It really felt like the digital world just collectively held its breath for a day or two. A huge, industry-wide problem.
It was. And as you can imagine, an outage like that, especially for a cybersecurity company whose job is reliability, took a toll on CrowdStrike's earnings.
I bet. Reputation hit plus costs.
Both. They had to significantly ramp up their marketing and sales spending, offer discounts to affected customers, try to rebuild trust. The financial impact was clear. Its operating margin fell,
How much?
down to 18% in its most recent quarter. That was down from 23% in the same period the year before. That's a noticeable contraction.
5 percentage points. Yeah, that's significant.
It is. Although, while that was indeed a major event, you have to give them credit. A year past the outage, CrowdStrike has actually shown remarkable resilience. They seem well-positioned to grow again.
Okay, so they bounced back operationally.
Seems so. In its most recent quarter, the company grew sales by a pretty robust 42% year over year. That's strong growth.
42% is definitely strong.
And their strategy of offering bundled discounts seems to be working. It's leading to more customers adopting multiple modules, multiple parts of their platform. That should help ensure high net revenue retention rates, which investors love.
Sticky customers.
Exactly. And longer term, as the company continues to scale its operations, its margins should theoretically start expanding again.
Okay, so operationally, things are looking up again. Growth is back. Strategy seems sound.
Which this raises the important question, right? If the company is recovering, growing so fast, why is the article suggesting caution for you, the investor?
Yeah, what's the catch?
The catch, according to the analysis, points directly, unequivocally, to its valuation.
Back to the price tag.
Back to the price tag. Look, the stock was arguably expensive before that outage. Then it took a brief plunge, sure, but it rebounded incredibly quickly and then actually surpassed its 2024 high.
So the market basically shrugged off the outage.
Largely, yes, in terms of share price recovery. Right now, according to the article, the stock trades at around 26 times trailing revenue. 26.
Okay, that's high.
And about 18 times sales estimates for the next year. To put that in perspective for you, investors are essentially willing to pay $26 today for every single dollar of sales the company generated last year.
That bakes in a lot of future growth expectation.
An enormous amount. And even though the stock price has pulled back a bit since the start of Q3, the article flatly describes this as an incredibly high valuation, especially given it just experienced that major setback.
So the recovery is happening, but the price already reflects that, and then some.
That seems to be the argument. It's the core reason for its overheated status in this analysis, despite the operational turnaround. Too much optimism baked into the price, perhaps.
Okay, that makes sense. So if our source suggests maybe hitting pause on CrowdStrike due to that sky-high valuation, then the obvious next question for you, listening as an astute investor, is where are the potentially smarter opportunities?
Right. Where's the better value?
Exactly. The article points us towards two, maybe more foundational players, both scanning out in a really key traditional area, firewalls.
Ah, the old guard, adapting.
Kind of. We're talking about Palo Alto Networks, ticker PANW, and Fortinet, FTNT. Both seem to be leveraging their strengths in network security to build out those comprehensive cybersecurity software suites we talked about earlier.
The one-stop shop play.
Precisely. covering everything from, on-premise security to cloud security, even real-time security operations, CCOPs.
Makes sense to build from your strengths.
Let's maybe start with Fortinet, FTNT. Market cap around $60 billion, trading at 77.75 thousand per the article.
Okay.
Fortinet launched its cloud-based security service back in 2020, and it seems they made really strong progress expanding client relationships, largely by building its cybersecurity suite in-house.
Interesting. Organic growth focus.
Yeah, less reliant on big acquisitions maybe. And they've shown some impressive growth metrics. There's SESI offering the Secure Access Service Edge.
Right. Combining networking and security for remote workforces, big area.
Huge area. Its annual recurring revenue, ARR, increased by 22% year over year in the most recent quarter. And their security operations platform grew even faster, by 35%.
Solid numbers.
Definitely solid. But what's particularly attractive here, according to the article, is the valuation.
Here we go. Less than CrowdStrike.
Significantly. It trades at less than 10 times sales and about 9 times forward revenue estimates. That's, roughly half or even less than half of CrowdStrike's multiples.
Okay, that is much more attractive on a relative basis. Definitely worth a closer look for value-conscious investors.
Seems like it. Then, on the flip side, you have Palo Alto Networks, PANW, bigger company, market cap around $122 billion, trading at 183.19 cents.
Another giant in the space.
They're also heavily into this platformization idea, really focusing on that higher margin software business. Similar in concept, I guess, to CrowdStrike's successful model.
Right, shift to software and services.
But Palo Alto has grown much more rapidly, historically, through aggressively acquiring smaller businesses, just buying up tech and talent.
The inorganic growth strategy.
Yeah, exactly. And it's worked well for them. In its most recent quarter, its next-generation security ARR grew 32% year over year. That helped lift overall revenue by 16%.
Slower overall growth than CrowdStrike, but still respectable, especially for their size.
And importantly, their operating margin expanded nicely, 340 basis points, which is, 3.4 percentage points? A really strong boost to profitability.
Good margin expansion is always welcome.
But here's where the plot thickens a bit with Palo Alto's latest big strategic move.
Oh, what's that?
Well, investors recently kind of pummeled the company's stock. Took a dive after it announced plans to acquire CyberArk.
CyberArk, yeah, they're big in identity security, privileged access management.
Exactly. Helps verify user identities, make sure they only access what they're supposed to. Critical stuff. The price tag, $25 billion.
$25 billion. Okay, that is a very large acquisition. I can see why investors might get nervous.
Yeah, the market reaction suggested many believed Palo Alto was, quote, overpaying for that opportunity.
Yeah.
Felt it was too rich.
Acquisition risk, integration challenges, plus the upfront cost.
Right. However, Palo Alto, being much larger than CyberArk, obviously sees a huge opportunity here. They think they can significantly expand CyberArk's customer base by cross-selling its identity solutions within their broader platform.
Leverage their existing sales channels and customer relationships. Makes strategic sense if they can execute.
That seems to be the bet. And despite that investor reaction to the deal, its valuation, per the article, stands at a price-to-sales ratio of 15.
15. Okay, so higher than Fortinet's 10, but still well below CrowdStrike's 26.
Right, and about 12 times forward revenue estimates, again, kind of in the middle there.
So bringing all this together then for you, the listener, thinking like an investor, what's the ultimate takeaway from comparing these three?
Yes, synthesize it for us.
Well, while both Fortinet and Palo Alto Networks are growing more slowly overall than CrowdStrike, largely because they have these bigger, more established legacy businesses dragging on the average.
Right, the law of large numbers.
Exactly, but the article makes it clear that they are each incredibly well-positioned to keep growing at a solid pace. Why? Because that demand for comprehensive, one-stop cybersecurity solutions, it's not slowing down. If anything, it's accelerating.
Makes sense. The need is definitely growing.
And crucially, both Fortinet and Palo Alto Networks trade at much more attractive valuations than CrowdStrike right now.
That seems to be the core point.
It really is. And this difference in valuation makes either stock, according to the article's analysis, a compelling buy at their current prices, especially when you contrast their long-term potential and more, let's say, sensible valuations against CrowdStrike's currently overheated status.
So, potentially better risk-reward profiles for Fortinet and Palo Alto, even with slightly slower top-line growth.
That's the argument presented. It's a powerful reminder for you that sometimes the best investment opportunities aren't necessarily the ones generating the loudest buzz or the highest growth percentages. Sometimes value matters more.
And there you have it. We've taken a pretty deep dive into this dynamic AI cybersecurity market today. We've understood, hopefully, the strategic importance of that industry consolidation and the undeniable power of data-driven AI.
Key trends, for sure.
We've seen how even a really strong performer, an innovator like CrowdStrike, can still be deemed, overheated purely because of its valuation.
Price matters.
While on the flip side, companies like Fortinet and Palo Alto Networks might offer more compelling opportunities, at least according to the source material we examined today.
Different profiles, different valuations.
So the key takeaway for you, our discerning listener, has to be the importance of looking beyond just those impressive growth figures. You really need to consider the full picture: a company's strategy, its position in the market, and crucially, its valuation.
Absolutely. It's about finding that sweet spot, right, where innovation meets sensible pricing.
Exactly, that sweet spot.
This raises an important question, maybe a final thought for you to ponder, building on our discussion.
Okay.
As AI keeps rapidly changing the threat landscape itself, making attackers smarter too, unfortunately, and as this industry continues its relentless push for those comprehensive one-stop shop solutions, how might the definition of what actually constitutes a complete cybersecurity platform continue to evolve?
That's interesting. What becomes essential next?
Exactly. Will new capabilities, maybe in areas we haven't even fully grasped yet, become totally essential in the next few years? And what new challenges or perhaps new opportunities might that present for these established players we discussed? Or maybe even for entirely new entrants we haven't heard of yet?
That's a crucial point.
Mm-hmm.
If the definition of complete is always a moving target, how do you as an investor even begin to spot which companies are building effectively for that next horizon versus those maybe just patching up old tech or making flashy acquisitions that don't quite fit the future picture?
It's tough. It's a sector that absolutely never stands still.
Definitely not. Understanding those future shifts, or at least trying to anticipate them, will absolutely be key to staying ahead in this space.
Yeah.
Lots to think about.